Guys, in today's video we're going to discuss Chapter 9 of The Intelligent Investor. In Chapter 9 of The Intelligent Investor, Benjamin Graham starts discussing investing in investment funds. Before starting with the main takeaways of this chapter, if you want to support the channel, you can subscribe to my channel. If you're interested in purchasing The Intelligent Investor, I also dropped a link in the description below to purchase your own copy of The Intelligent Investor. But if you want to trade yourself, I also placed a link in the description to sign up to Robinhood, which is a platform that allows you to trade commission-free. And if you use that link, you will also receive a free stock up to a value of $400. Okay, without further ado, let's start discussing the main takeaways of Chapter 9 of The Intelligent Investor. So in Chapter 9, Benjamin Graham analyzes whether it's possible to choose investment funds based on comparative performance. So what we mean by choosing by comparative performance is choosing an investment fund by finding out what fund has made the best showing over the last period and assume from this that its management is the most capable and will therefore do better than average in the future. According to Benjamin Graham's research, this kind of approach makes sense, and it's possible to choose an investment fund by comparative performance because according to his research 5 years results tend to carry over to the following 5 years. However, this is true so long as the data does not represent a large net upward movement of the market as a whole, because in that case Benjamin Graham believes that it's possible that fund managers achieved those better than average results by taking risks, and as long as there is a net upward movement of the market as a whole, they manage to get away with it for the time being. This of course will no longer be true if there is a market drop. The second point that is discussed, and I think it's very interesting in the chapter, is about the size of a mutual fund or an investment fund in general. So what Benjamin Graham says here is that there is strong indication, according to his research, that the smaller size is a necessary factor for obtaining continued outstanding results. All financial studies indicates that a large fund soundly managed can produce at best only slightly better than average results over the years. So we're talking mainly of exceptions. But why is that? Well, an explanation is provided in the commentary to Chapter 9, written by Jason Zweig. He lists several reasons why big investment funds generally cannot perform better than average results. So first, migrating managers. So it's simply unlikely that a manager stays with a fund for a very long period of time, because as soon as this manager seems to have a gift in stock picking, everyone wants him. The second reason is that when a fund earns high returns, investors tend to notice that and tend to pour hundreds of millions of dollars in a matter of weeks. That leaves the fund managers with very few choices. Let's give an example. So let's say that there is a company that has a very low market cap. If the investment fund is too big, it might even be possible that buying more shares of this company won't even be permissible under federal law in terms of level of ownership. As a consequence, when the fund becomes too big, it becomes impossible to buy the same kind of small companies. Additionally, when the investment fund becomes too big, there are rising expenses that tend to lower investment's return. Okay, so the reason provided in the commentary seems to give a causal explanation to why all these financial studies and evidence show that investment funds generally do better if they are of a smaller size. Next, on page 238, Benjamin Graham starts analyzing whether it's better to buy open-end funds or closed-end funds. Open-end funds are generally mutual funds, even though hedge funds and ETFs are also included in open-end funds as a category. The difference between open-end funds and closed-end funds is that open-end funds have unlimited shares that can be sold to everyone who wants to buy them, while closed-end funds have a fixed number of shares. So once it starts operating, that's it, no more shares. The most important difference, however, is the consequence of the first one, which is that open-end funds have many thousands of energetic and persuasive salesmen that tend to increase the fixed premium above the net asset value at which the open-end fund is sold for. This is to cover the salesman commissions and other expenses that open-end funds have, while closed-end funds are generally sold at a discount. Another characteristic of closed-end funds is that, like a mutual fund, a closed-end fund does not issue new shares directly to anyone who wants to buy them. Instead, an investor must buy shares not from the fund itself, but from another shareholder who is willing to part with them. Thus, the price of the shares fluctuates above and below their net asset value, depending on supply and demand, making the stock a little bit more volatile. So if you explain the difference between the premium and the discount on the net asset value as only a consequence of the rising expenses of open-end funds, then of course it becomes very clear that buying a closed-end funds will be better than, on average, than buying an open-end fund. So Benjamin Graham says that if you want to put money in investment funds, buy a group of closed-end shares at a discount of say 10 to 15% from asset value, instead of paying a premium of about 9% or more above asset value for shares of an open-end company. Assuming that the future dividend and changes in asset value continue to be about the same for the two groups, you will thus obtain about 1/5 more for your money from the closed-end shares. A logical perspective. Benjamin Graham finally explains that the open-end companies do not enjoy superior management, or at least this has never been proven. And if the answer is sought in the comparative results of the past 5 to 10 years, then it seems that closed-end funds perform just as profitably as the open-end funds, with the difference that you're paying a premium for the open-end fund. If there are all these problems with mutual funds and open-end funds and in choosing the kind of investment fund, a possibility would be also to invest in an index fund. This is a possibility that is dealt with in the commentary. And late in his life, after writing The Intelligent Investor, Benjamin Graham praised index funds are the best choice for individual investors. And the same did Warren Buffett. Actually, I dropped a link in the description below that is collecting all statements of Warren Buffett over the S&P 500 and other index funds, and why ETFs should be an interesting choice, probably the best choice for individual investors. And the reason is that these index funds generally track the market. So instead of trying to beat the market, they own all the stocks at the same time, or most of them. By doing this, they will never, of course, beat the market, but at the same time they will beat most funds over the long run. In the commentary, Jason Zweig lists also the reasons he believes are the reasons behind some investment funds' ability to beat the market. And those reasons are that there are very low expenses, so low-cost funds. The managers are the major shareholders, which means that they actually believe in the investment strategy of the fund. They dare to be different, so they don't do what everybody else does in terms of investment strategy. They don't hype their returns, meaning that they don't advertise. Just as Plato says in the Republic that the ideal rulers are those who do not want to govern, the best fund managers often behave as if they don't want their money. And finally, they shut the doors before they get too big. And I already explained why Benjamin Graham and Jason Zweig think that big funds cannot do better than average results, with very few exceptions. Alright, thank you for watching. Don't forget to subscribe if you like the video, and if you want to purchase the book, I will drop a link in the description below, as I said at the beginning, to purchase your copy of The Intelligent Investor, which I think is a great way to start understanding about how to invest your money in the stock market. So thank you for watching, and bye everyone.